we love to hold on to this belief that discretion is really important. And I think a lot of the times we like to hold on to that because it gives us that easy out. It gives us that way of explaining our mistakes. It gives us that way of dealing with the disappointments of trading.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. Walter here. Hello, Darren.
Good evening, Walter.
So we have this question about losing money, and I'll read it for all of our listeners here, and we're going to dive into this one today, Darren. This is from a listener. I keep on losing money whenever I trade. I can't clearly determine the direction of the market trend. It's a big challenge for me. So what do you say about this?
Well, if I keep losing money, then I would do my trend analysis and go the opposite direction. If the trend is determining the direction is the problem, that's a pretty simple solution. But probably not what
yeah.
But probably not what.
It could be something different though, like stop placement or something, right?
Yeah, I think it could be that you're trying to get in with too tight of a stop for your particular time frame, and I'm a big fan of a wider stop. I think people overcomplicate the trend because it's very subjective. I mean, are you talking about a trend that's going to go on for a month? Are you talking about like the current movement? Trend is such a broad subject, and trend trading doesn't necessarily suit everyone. And also, you should say that you don't necessarily have to determine the direction to trade. You can use other triggers to decide which direction you're going to trade. And pretty much every day, if you're trading intraday, there's going to be opportunities short and long, regardless of what the trend is. So I think people need to keep things very simple when it comes to trend, and also have realistic expectations about picking the direction of the trend can do for you. It's certainly not a fix-all determining the direction, and trend trading can be very challenging for a lot of people.
Yeah, and I think most traders aren't trend traders. I think most traders who have difficulty trying to trade with the trend, it's because they've been told in some book or something, or some forum, that you have to trade with the trend. So there are advantages to not trading with the trend. The people who trade counter trend or swing trading, you can do well with that as well. You don't have to follow what the book says. And I don't know what's going on with this trader here, but that could be the case, that you're actually doing this or looking to do this because you believe that's the only way to go. And I don't necessarily believe that. One of the advantages actually about counter trend trading or trading at the end of the trend is it happens often that the market moves really, really quickly. So what can happen and take a long time, sort of slowly unfolding trend, it kind of moves up, because the trend, typically you'll get a move with the trend. Let's say you've got an uptrend. It'll move up, then it'll kind of rest for a while, then it'll move up strongly, then it'll rest for a while, then it'll move up again, sort of stair steps. And then what happens at the end of the trend? Well, often it will collapse and go against the trend really quickly and very fast. Now, sometimes it'll do that, and then it'll consolidate and kind of get stuck in a box. But the point is that there are strategies that you can employ to trade against the trend and make money. And most traders, I believe, have the psychology that is more conducive to trading, swing trading or against the trend, than trading with the trend. Very few traders actually have the psychological makeup to do well over the long haul at trading with the trend. That's my belief. Now, you can trick yourself. So you can trick yourself in terms of if you want to trade with the trend, you kind of wait for those little tiny baby retracements against the trend, and then you get in. So it looks like, if you zoom in on the chart, it looks like you're trading a counter trend move or something, because it's like, you're taking this little rebound that's gone against the trend. So it's the end of that move that you're banking on. So you can do that if you want or whatever. But the point is, I would say to this trader, are you sure you want to trade with the trend? If you're having difficulty determining the direction of the trend, you can do as Darren says and just trade the other direction. But I think it's probably something more like, you could be struggling with the fact that the market's been going up for so long, and you keep thinking in the back of your head, when is this going to end? Or your stop loss is so tight you just keep getting stopped out, or you're getting in at the wrong phase of the trend. A lot of traders like to get in on the retracement of the trend, so when the market goes against the trend, they get in at that point that they think is the end of that retracement. And other traders like to see the market make a new high with an uptrend or a new low with a downtrend, and that enables them to get in as the market's breaking out and going further. So it sort of depends on how you see it, but I would question whether or not this trader actually believes that trend trading is the right thing for their psychological makeup. So yeah.
I think, as well, there is a lot of losing in trend trading as well. If you truly are a trend trader, you're going to lose a lot of trades, and it's going to be a very small number of big wins. Generally, I'm kind of generalizing a little bit, but usually successful trend traders will have like 2 or 3 trades that really bring home the money, and a lot of losers in between. It is a losing game, trend trading, but those big winners are where you get your profit from generally. And another way to kind of approach it as well is to not think in terms of trends and think in terms of movement. And it could be that he is trying to trend trade but then enter in at the worst times in the consolidations when you're much more likely to be stopped out. And maybe you're better to look at it in terms of kind of velocity and movement, and wait for the markets to really start moving, and then look for your entries into that movement. Could be another approach. And I think a lot of the stuff I read about trading comes from or stock traders or traders who are trading very big accounts over longer periods, and there's less information there about kind of retail traders trend trading. So I think if you're taking your ideas from something that is not very similar to how you're going to be trading, then you need to sort of take that in context and perhaps tweak things so it suits your style of trading better.
That's a great point. One of the things I read recently was how somebody was talking about why people shouldn't trade this way because the funds don't trade that way. And my immediate reaction was basically exactly what you said, Darren, which was this trader was saying most of the funds don't do this, and therefore you shouldn't do it either. Okay, basically saying you show me a private fund that does this, and then I'll believe that this is a viable strategy. In other words, it's only the hedge funds that have the viable strategies, and that all retail traders should fall in line. And I completely disagree with that. I couldn't disagree with it more, because if you talk to hedge fund traders, if you talk to bank traders, if you talk to those people who are, quote, pros in the industry, first of all, you'll be amazed at the difference in approaches. There's a wide range of differences in the way that different organizations trade and different philosophies. And the other thing is, we have advantages as retail traders that they don't have. Okay, there are amazing advantages that you have as a retail trader that they simply don't have. There's a lot of worry. There wasn't so much a few years ago, but nowadays there's a lot of worry about getting into trouble. So, for example, like with the banks, it used to be really, really easy for the banks to make money in Forex, and the reason why is Darren's sitting there at the desk at Bank of America, and Bank of America gets an order in from Toyota. Toyota's going to, and they've been talking about it all week, Toyota's going to put in a large order for U.S. dollars. Okay, they're going to sell yen and buy USD. All right, well, you know that, Darren, sitting on the desk, so you can run some discretionary trades for Bank of America because you have a Bank of America account. You have an amount of money that you can trade for them. You can run that order in front of the Toyota order, knowing that the Toyota order is going to move the market a little bit. So it's like front running, and with stockbrokers, you go to jail if you do that. But the banks have often done that. So now what's interesting about this, it's not that easy anymore. So some of the regulators have stepped in and said, hey boys, you can't really do this anymore. You can't put your order in front of the Toyota order, you know. So what they do is they get a little bit tricky. Is they'll do things like instead of going with USD Japanese yen, they might go in with the Euro yen or something like that, knowing that the yen is going to weaken a little bit, probably against the euro as well, in addition to the USD. So they kind of work their way around it in different ways, but I guess what I'm saying is just because they're doing that doesn't mean that you should do it. So how can you do that as a retail trader? Is there any way that you can adopt a similar strategy to that, the one that I just explained that the fictitious Bank of America does? Of course not. You can't do that. Just like they can't use 500 to 1 leverage, right? They don't have 500 to 1 leverage. Or whatever it is, 100 to 1, 200 to 1, 50 to 1 that you have in your retail trading account. So you have extreme advantages. And I also, this is something that we talked about in one of the workshops where I said, look, because there was a pro trader there, and he was a bank trader, and I said, you tell me if the other bank traders would be amazed at, because I'm saying that what retail traders do is amazing to what some of these bank traders do. I said. And he said, yeah. He said, absolutely. They would be amazed because the things that retail traders have to come up with to make money are completely foreign to those who are, quote, pros in the market. It's a completely different world. And the way that people make money in retail trading is completely different to the advantages and the methods that you use in the pro world. So I don't think you should look to those. To follow up on what you're saying, Darren, I agree. I don't think you should look to what somebody was doing in the futures market in 1985 or what the hedge funds are doing in 2017. You know, I don't think that's what you should be doing. I don't think that's the case. I think you should, one, define who you are as a trader, what you believe in, and two, back test the crap out of that, get really comfortable with it, become an expert, get a lot of experience with that approach that you believe in because it fits your beliefs and you're going to stick with it over the long term. Don't let me or Darren or anybody else tell you that this is what you should be doing or not be doing. What you should be doing is following what makes sense to you and not trying to duplicate what some trader did with stocks, with penny stocks, 15 years ago or whatever. That's not... it's a different world. You need to do what makes sense to you. And so for a lot of traders, what does that mean? What do I mean? What makes sense to you? Well, you're probably going to be a trend trader, like we talked about, or you're going to be a reversion to the mean type trader. So the market's sort of gone so far, it's going to snap back. Or you're going to be a swing trader, so you're looking for those points where the market reverses. Or you could be a movement trader. And I'm going to call you a movement trader, Darren. You don't have any idea about any preconcept. It's just the point is the market's turning around here. There's a little bit of a turn on the chart, so it may go pretty far, so I'm going to take a trade here, right? So there's a move, basically. There's a move down or a move up, so I'm going to get in. So it's kind of like swing trading without all the fluff, really.
Yeah, definitely. It's basically not having a directional bias, just having... if price is going down, I'm going to sell. If price is going up, I'm going to buy. And I'm only going to manage my buy when price starts going down again. And then just wrap some rules around determining what deciphers that it's going up and what deciphers it's going down. And nothing more than that, just letting the numbers play out over a long period of time. And you have to accept that you're only going to win half of your trades. You get back to the coin flip scenario, really. I only win half of my trades, but I win slightly more on my trades than I lose on my losers, and I have a high frequency of trades, so I'm not sitting out of the market a lot of the time, which is something else we're told that we must do, and the numbers play out over time, and that is just another approach to dealing with the problem of trading.
So yeah, one of the things that's interesting to me, Darren, about your style is, and it'd be cool if you could talk about this, because you had a way of doing this where you were kind of doing the opposite to what you do now. Like you were doing this in a way where you were looking for the big winner, like the trend followers do. So in a way, you were kind of at one point anyway, you were doing it so that in a way where you're like, okay, the market looks like it's going this way, and I'm going to start taking these trades in that direction and trying to get the really big result. knowing that a lot of times it's not going to happen, but eventually you would hit it. And now it's kind of changed to where, like you say, you're 50-50 or whatever it is, 51-49, 52-48, whatever it is, where it's basically just as many winners as losers. It's just that the winners are a little bit bigger, and you've got the volume of trades under your belt. So can you talk a little bit about how, the changes going from a low win rate with really big winners to a little bit of a higher win rate, a 50-50 sort of result, where the winners are slightly bigger, and kind of how the psychological things that go with that in terms of, trading the low win rate big winner versus the slightly bigger winner with a higher win rate?
Yeah, I mean, I was stacking my positions and holding them so they built like a position trade. The reason I kind of favoured that was because it backtested so well in terms of profit. But what I discovered was, although I found the actual process of trading that way fairly easy, I mean, all trading strategies have their issues. The problem was with it that if I made a mistake when I had a very big position, to get to that stage, I'd have to have taken a lot of losses. Okay, so I'm in quite a chunk of drawdown already, and I have a big position in one direction. And if I made a mistake and there was a fundamental announcement or something major, I could then lose all of that position as well. And that happened to me earlier in the year. It was something to do with the euro. I'd built a position short over about 8 weeks, and one news announcement reversed on me. And, I knew the news announcement was coming up. It was an obvious time to kind of manage my position. And I made a mistake, and it cost me nearly 3 months of profit in one afternoon. So that was the issue with that style of trading. And, obviously it can work, but that was a problem for me, having that big loss. So, I kind of adjusted my approach, although the actual core strategy was exactly the same. I was still entering the same way. The setups were the same. I just adjusted the money management. Now, the problem with that is my current way of trading. The problem with it is that you have to accept that your results are going to have a great deal of variance. Although if you test it and you do an equity curve for it, it looks really nice and smooth. There's a lot of periods of trading all week and only getting a very small profit, or trading all week or like having a series of losing weeks. And then you have like some weeks where price really moves and you have some really big winners, and that averages out over time, and that's really nice. So the issue you have going forward is on the long run, you have to make sure that you stick to the process, and really need to avoid looking at your profit and loss all the time, because it's always going to be disappointing. You're going to have great weeks where you've like won 400 pips, and then you'll have 3 weeks where you lost 80, 120, lost 120. And, those 3 weeks, just talking about it now seems okay, well, I could deal with that. When you're actually in the moment and taking trades every 4 hours, sort of 15 trades a week, and you're sitting and the clock is ticking by and your profit and loss is just slowly creeping down, it's really hard to stick to your process. So you have to keep in mind that back testing that you did, or your previous trade results, and like you were saying earlier, look at the group of trades and the results of them. And so when I'm 200 pips down like I was last week on Wednesday, it seems like a big issue. When I look that I'm 5,000 pips up for the year, then that 200 pips isn't a big issue. And when I look at my worst trading week result, which was minus 400 pips, again, it doesn't look like a big issue. They're essentially the same emotional problems, but they just kind of play out on a different time frame.
Yeah, that's interesting. So when you were talking about the big position that was stacked and then the news result came, so you were slipped? Is that why it didn't work out, because the stops were slipped on that one? Is that what happened?
No, because to be honest, I had too much discretion in my exit plan, and that's something that I'm kind of slowly changing my attitude on. I kind of had the notion that you should have lots of discretion on your exit, And then I kind of was learning, well, actually, you need some discretion, but there needs to be some hard and fast rules as well. You can't just be completely, decide what you're going to do in the moment. And now I'm even kind of considering the last week I've been doing a lot of back testing on a completely mechanical exit, which is something that I kind of swore I'd never do, because it was something I kind of convinced myself that you couldn't do. I kind of had this belief that you had to have some discretion in there, and I'm kind of changing my view on that now, because I just did 300 weeks of back testing with a completely mechanical exit, and it does okay. And it was interesting, whilst I was back testing it, I could see the moments where this is where my mind would be screaming to use some discretion. But it's comforting to know that you can kind of approach it from a mechanical point of view as well. If your risk model's good and you let it play out over a long enough period, then you can still make profit trading that way.
Yeah, that's fascinating. I think that I know a few traders, obviously, like in the forum, Rima uses a mechanical exit, and we've spoken to James. I think James also uses a mechanical exit for some of his systems, where he just kind of, once he gets in, he just kind of walks away, and then at the end of the week he has a sneaky peek to see what happened. I think it makes a lot of sense, because I think, I guess to me it makes a lot of sense for you, because I think your basic philosophy is to stay away from, don't cloud up your execution with analysis, basically, is the way I view it. And I don't know if that's the same way that you would, but that's the way I view your trading.
Exactly that way, yeah.
Yeah. So that kind of makes sense to me that you would end up that way, because you're definitely not using any real, like what you would normally call analysis in the entry. And so your last thing that you're holding on to was your exit. And now you let go of that too. It's kind of at that point where this is where a lot of traders would start thinking about automating it or whatever. And I know you probably are like me. It's not necessarily the first thing, it's not necessarily something you're comfortable with, but I think that it would make a lot of sense. And in some ways it would kind of free you up too, because you get into the trade, so you've made that decision, and then if you could snap on a mechanical exit, it would kind of allow, I guess it would allow you to it would free you up from that last piece of decision making. The only thing is, if you had another trade come in, like in the opposite direction, do you know what I mean? Like, would the mechanical go off, or would you have two positions, or would the trade be over and then the other one? You know what I mean? Like, because I know you do some hedging and things like that. We've talked about that before. So that's the only...
Yeah, and I have been, working on removing that discretion all the way through. Before I had basically, I'd wait for, once I was in a trade, I'd wait for a specific trigger. And once that happened, then I would have 3 options. And my mantra was that it doesn't matter which one you pick, because you don't know what's going to happen next, but you need to pick one of these 3 options, like moving to break even, just taking profit, or setting up a hedge trade. And then I thought, well, if it doesn't matter which 3 of these you pick, then surely all 3 of them should work on their own as well. So that's what I started doing. I started back testing. Okay, well, I'm just only going to use option 1, and I'm going to run that back test for 250 weeks. And then I'm only going to use option 2, and I'm going to run that, and so on and so forth. And it was quite enlightening. And I think I had one 20-week period. I back test in chunks of 20-week periods, and I had one period where I didn't make profit, and it was like -5 pips for the whole period. And I'm sure like trading that live would be pretty painful, but it was really enlightening for me. And this is kind of the route. This is kind of the path I'm on now. I'm at the point where I'm basically constantly going over my beliefs of what is true and not true, and testing them and taking them to the extreme and seeing if any of my assumptions are right, and really kind of trying to boil my strategy down into like the E=mc², if you like, the perfect, elegant, simple equation to suit me. Obviously it suits me, and suits some other traders are kind of finding it suits them as well. But on the subject of automating, again, it's something that I've had a belief that it's not the right way to go. And I think it's because we love to hold on to this belief that discretion is really important. And I think a lot of the times we like to hold on to that because it gives us that easy out. It gives us that way of explaining our mistakes. It gives us that way of dealing with the disappointments of trading. It gives us that way of dealing with the bad weeks, and we want to be able to explain away the bad weeks rather than just accepting that however you trade, there are going to be bad times. And I am exploring the automation now, and if I can get it to work, I'll certainly use it. If I backtest something and it works, I know that it's about the process. And if I can automate that, then I'll certainly set up a second account and I'll run it. And no doubt it'll end up being far more successful than I've ever been trading it manually. Well, I hope it does. Anyway.
Yeah, that's funny. I think what's interesting though about this approach is that you're taking an approach that most people don't, which is you've traded it for a while, and then you're like, well, you're slowly moving from the discretionary, or not really discretionary, but sort of the manual execution of it, I guess. There is discretion, but you're moving that into the automation, or you're going to test it that way. Whereas a lot of traders, they don't go through that first step. They just get the automated thing and they go, yeah, woohoo, let's go. And I think that's a very different mindset, isn't it? Because you don't know it well. You don't know it well enough to anticipate what's going to happen in the future. But if you actually traded it for some time, you do, and you will know what to expect. And my big thing has always been, and I've said this over and over again to those traders who say, oh, let's automate this or whatever. All traders are discretionary traders, and the reason why is because even if you're trading a robot, you're the one that flips it on and off, and that's the one thing that people forget to account for is user error. You're the universe for that system. You flip it on and you flip it off. You turn it off when the non-farm payroll's coming up, or you turn it off when this election result's coming out, or whatever reasons you have. You're the guy that gets to turn it on and off. So it's a discretionary system, isn't it? Because you decide when it's on and when it's off. So if you're one of those people who's traded it for a long time and then you automate it and then you say, yep, I'm going to let it go all of the time, that's about as close to automated trading, I think, as you can get. But I think a lot of us just can't do that. We have reasons to jump in there. We come up with reasons to make ourselves important for the process. So yeah, it's tricky.
Yeah, and I think people tend to automate systems that look too good as well. And if it looks too good, then I'm dubious about its longevity, because it's probably trading some sort of anomaly based on the period it's been tested on. So I'm always kind of wary of results that are completely out of the park. And that was kind of encouraging for me when I did the back testing to see that it didn't always perform well, and there was weeks that were really big wins, and there was really big losing weeks, and in between there was a nice kind of average, and that kind of gave me a little, that felt real. That felt that I could I was perhaps onto something that would perhaps stay the course over the long run.
Yeah, that's fascinating. Yeah, we should. I really like this. I think we should actually have a whole webinar on this idea of sort of making trading easier, automating it. I think our whole webinar, a podcast on this. I think it would be kind of fun to do that. So yeah, this has been really cool. Yeah. I didn't know you were going down this path, Darren. This is kind of interesting. Yeah, I really like this. Cool.
Yeah. I think the problem has always been for me as well is that I can't program. So I'm always, even when I explain a very simple system in my head to somebody to trade manually, they rarely get it the first 1, 2 or 3 times, and so I'm always having to try and get my ideas through to someone that can program them, and that adds another level of complexity to it. yeah, let's definitely do a podcast on this, because the whole automation thing is kind of new for me, and it's bringing up interesting things for my manual trading as well.
Great, that's great. Well, thanks for your time, Darren. We will definitely see you next time, and we'll dive into that. That sounds like a good topic. There's a lot in it, obviously, here. Yeah, a lot in it. All right, thanks, Darren, for your time.
Cheers, Walter. See you soon.